Are we live? Oh, fantastic, we're live. Good evening and welcome to this live Ask Me Anything About Property Investing with myself, Saj Hussain. I'm here every Monday evening at 8:30 p.m, streaming live on various platforms. That's Facebook, YouTube, Instagram, LinkedIn, Twitter as well. So if you've got a question for me, make sure you pop it in the question section below and we'll do our very best to get that answered for you. We'll just try and answer them in the order that we have, but make sure you pop that question into the comment section, even on the platform that you're watching on. As I said, I'm here every Monday really just to answer your property questions. On my YouTube channel, I have about 3 videos a week to really help you get further faster in your property investing journey. So I know a number of people here regular every week, which I really appreciate you taking the time to join me. And some people kind of drop in and see here for the first time as well. In fact, just say hello. Make sure you can let me know you can see and hear me okay. And then we'll get started in just a moment. So I've got Khalid helping me in the background with the tech. So Khalid, if you could pop up the first question when you're ready and we'll get started. So our first question is on YouTube from Sanil M. For a flip strategy, if we're buying property, refurbish and sell, do we need to pay stamp duty and additional surcharge? So yes, unfortunately, we do need to pay the stamp duty when we purchase. So if you're buying a property which is not your home, or a second property, you'll need to pay the stamp duty on that purchase and any the surcharge as well. So currently we're only paying the surcharge up to £500,000, i.e. the additional 3%, and then the current stamp duty holiday, if you like, is up until March 2021 right now, which might change in the future. That's what it currently is. So yes, if you're purchasing a £100,000 property, you'll have 3%, £3,000 to pay as stamp duty. This is where if you can purchase a property, say with option agreements and things, it'll give you control over the property. And it also means that you don't have the stamp duty. So if it's possible to do a creative transaction, it's worth exploring. So I think you had a second part of that question popped up, but it just disappeared. Let me see if we can just get that back up on the screen. For flip strategy, which is the best option to buy in own names or company names? Yes, so again, it depends on your longer term objectives. What is it you're trying to achieve? So if you purchased a property in your own name, and essentially the difference is around taxation. So if you purchase in your own name and you come to sell that property, then you got capital gains tax to pay, but you'll have an allowance. So that means you can utilize that allowance as around £12,000. And let's say you've purchased in you and your partner's name, there's 2 of you. So that's around £25,000 allowance that you could earn and utilize and not pay any tax on. And if you're purchasing in companies, then it's corporation tax that you're incurring. So it's thinking about which is going to be a more tax efficient way for you. So the answer to the question, which is the right way, ultimately depends on what your personal circumstances are and how you want to try and make it more tax efficient for you. So thank you for that. So we'll get our next question up in a moment. Remember, if you're watching on whichever platform you're on, pop a question into the comment section. I'll do my best to answer that. Also, let me know where you're watching from this evening. Say hello as well. So I know lots of people watch and don't ask any question, but that's fine. Just say hello whilst you're here. So next question is from Segan on YouTube. Good evening, Saj. How do I know if there's any restrictive covenants on a property before making an offer? This is a really good question. I learned this the hard and painful way when I was doing a deal a number of years ago. It was a below market value deal. We got very close to completion, and then we realized actually that the seller had ended up allowing another charge to be put onto the property, which for a car loan that their son had taken out, but they were the guarantor, and it was about £7,000 that ended up being put onto the property as a charge. Now, although this was a charge, not a restrictive covenant, the lesson I'd learned was actually I could have found this out nice and early by just getting the title documents. So if you go to the land registry website, the official land registry website, and it's about £3. Well, it is £3. You download the title document. If you want the plan as well that shows the boundaries, that's another £3. So £6, you can get both documents, and the title document will show you if there's any covenants, any charges. It'll also verify the name of the person when they purchased it, often what they paid for it as well, and if there's any lender currently on the property as well. So that's something we're getting to the habit of doing now. So as soon as we agree a deal, we go and get those documents, or we check through if there's any issues or concerns, we deal with them straight away, rather than let the solicitor crack on with the purchase and then find there's an issue further down the road. And of course, when the solicitor's doing the searches, then there's other covenants that may not be obvious that might appear, but then that solicitor will find those for you, hopefully. So hope that helps. Hope that answers your question there. Our next question this evening is from Jamie on YouTube. Hi Saj, how do you price up and decide whether to cosmetically refurb, back to brick, or demolish completely and rebuild? Yes, so it's quite a range. So the way we talk about it is whether it's a light refurb, a medium, or a heavy refurb when we come into refurbish a property. And the best way to work that out is to establish what is the end goal of what we're trying to achieve. And let's say it's a sale that we want to achieve at the end. So we look at what's the value that we think the property is going to be worth, what's the maximum value that we can achieve, and what do we need to do to that property to achieve that value. And then you work backwards in terms of, okay, if I spend this much money and this is what I'll pay for the property, am I going to achieve the profit that I want from the property? And let's say you're going to do a BRRR where you're refinancing it at the back end. Then you need to be confident of what that value is going to be at that property when it comes to the refinance stage and the surveyor comes back out for the lender to value that property. And this is really about doing good comparable research what else is being sold that's similar to what it is you're trying to create, and then looking at the cost of doing that. And really, as I said, it's working backwards to establish which is going to be the right way. So for instance, you could, let's say you purchase a property for £100,000, you spend £10,000 on it, you might be able to sell it for £140,000. So, you get a nice profit, £30,000, nice and easy. On the other hand, you might purchase for £110,000. You might spend £100,000, spend £50,000 on it, so you're up to 150. But your sale price might only be, say, 180, because that's the limit or what you can achieve there, even if you've, when all singing, dancing, double story extension, loft conversions, etc. But your profit's still only £30,000. So is it worth all the effort when actually you could have achieved a similar profit with only spending less money? So I think working with the end in mind, what is it you're trying to achieve? What's the outcome you're trying to get from that, and then work out what is going to be the appropriate amount to spend on it to help you achieve that. So I hope that helps there, Jamie, with that. The next question this evening is from Charan, also on YouTube. What are your thoughts on the current boom we are seeing? How does this fit into the 18-year cycle? Will this continue, or do you see a correction coming soon? So, Sharon, we sometimes people talk about a 10-year cycle, a 12-year cycle, an 18-year cycle. There are cycles in the property market for sure. There's no doubt about that. But it's not scientific that it happens every X number of years, every 7, 10, 12, 18, whichever person you're listening to might have a different view on that. The market goes up and down and it changes. It's not set, and it's not set in stone. And there's various things that will happen that will trigger major events. So, for example, last time it was a credit crunch. It was the squeezing of the lending markets that ultimately caused the property market to crash. And this time, it looks like with the pandemic, this is what will ultimately cause a price slowdown. Now, earlier in the year, I was saying, if you're watching any of my previous recordings of this, if you go back and watch, because we've been running these for a year, I think we're on episode number 42 or 43, I can't remember exactly. So we've been running this for nearly a year. If you go back to previous episodes, I was talking about earlier in the year that I think the market's probably going to crash towards this time of the year, around November. However, that hasn't happened. The market's still quite strong, although it seems like we're in a recessionary environment. The property market's still quite strong. Prices are healthy. Property selling very quickly. There's a massive backlog in conveyancing, and you think, what's going on? And that's because the property market's constantly being stimulated, and it's to help it move forward. So, for example, the stamp duty holiday, if you like, that's encouraging people to go out and look at property. When we had the lockdown the first time round, after that, people had come out and they were still keen to look at property and go out and buy property. So that pent-up demand had hit the market as well. There's very limited stock in terms of what's in the marketplace, which is pushing up demand. There's very, very cheap money around. The rates are the lowest you'll have ever seen, probably in our lifetime, in terms of being able to access money at those sort of rates. Also, there's talk from the government of 95% mortgages for first-time buyers. All of these things are stimulating the property market and keeping it moving. Now, I think the government are being very, very smart and very canny about what they're doing, and they're putting this slowly. They keep putting things into the market to prevent the market crashing out, because they realize the importance that the property market has on the overall economy. So personally, right now, I don't think we're going to see a big crash. I don't think it's heading that way. I think the government has already put so much money and support and effort into the economy that they're going to continue to do so. They're not going to let it fall flat on its face. And what we might see is a slowdown in the property market as to a crash and falling flat on its face. So rather than, you know, a 15-20% crash out, a price reduction, it might be, it's, you know, 5% or maybe maximum 10% as the market starts to slow down. But of course, this will still present opportunities. It doesn't need to have a crash in the market for there to be opportunities, and we should still be out there looking for deals. Just earlier on, I was being interviewed today on somebody's YouTube channel, and we were talking about this, you know, what's going to happen in the market and whether we should sit on our hands and waiting. I think that's the one thing we should not be doing, is sitting on our hands and just waiting. What we should be doing is looking for opportunities that fit our requirements and our criteria, whatever that might be, and look for really good deals rather than just okay or good deals. In case the market softens a little bit, you can absorb that change. So I hope that helps. I hope that answers your question for you there. Next question, just checking over here on LinkedIn as well. I think we might have a question on LinkedIn. Khalid, if you have a look at that, you can chuck that up. Yusuf saying, hi Yusuf, how are you? Thanks so much for seeing you here. What's your take on family investment companies? Any real benefits? I don't have a huge amount of experience in this. I have had the conversation with our accountant about it. I think there can be long-term benefits. It's about transferring assets generationally and being able to benefit from that, utilizing everyone's tax allowances, combined SASs. There's so many benefits if you have that family network and support. I don't have a huge amount of knowledge on that, so it's probably not one that I can say a lot about. But thank you for the question there, Yusuf. So let's see, what's our next question. Next question from Anne on LinkedIn. So there are people watching other than YouTube then today. So we have some other people watching. Thank you so much, Anne, for your question. Hi, Saj, do you have use? Oh, from Italy. We just flip back to the question there, Kyle, so I've not read it. I'll just get that up in a moment. Hi, Saj, do you have use Deal Analyser? How do you decide what's a good buy for your business? So great question. So what's a good criteria? And this is a really important point. And this is going to be different for everybody. So my Deal Analyser, my criteria might be different to yours, and might be different to somebody else who's watching. And that's because the reason we get into property and why we're investing in property and the outcomes we're trying to achieve in property will be very different depending on where we are in our lives and, you know, what our objectives are essentially. So for instance, now for some people, they want to get into property because it's about creating an additional little bit of income. So they want to make some more income, a side hustle, whatever you like. Then for some people, it might be they actually want to get out the day job. So they want to build up enough income from property. So it means they can give up the day job and get out of that. And for some people, it might be they don't actually need the cash flow right now. These are long-term investments. You know, they might be high earners right now. So this is investing for their future. So they have a substantial income, a substantial asset base, and building wealth for the long term or generational even. So, you know, the reasons people get involved in property is very different. So when you take that into consideration, then the type of property investing people do will also be different, and the return expectations will be different. So for example, some people right now want immediate cash flow. They want just the maximum cash flow they can achieve. And for other people, it might be they're okay with a lower cash flow right now, but really they want to be buying in areas where they're going to get long-term capital growth. So it ultimately just does depend on your personal criteria. I think everyone's criteria is different, but this is the place that I think we should all start. When we're looking at property and property investing, why is it you want to get involved, and what is it you're trying to achieve, and then which is going to be the right strategy to help you do that. Then put together a criteria in terms of what type of investment is going to fit that criteria in order for you to be able to achieve what you want to do. And I think this is probably one of the biggest mistakes many people make when they're starting property. They're not quite sure what they're looking for. They're not really clear on what's a good deal. They're just saying, I want a deal, I'm looking for a deal. I think, what is a good deal? And, you know, often they don't even see them when they turn up, when they're staring at them in the face, because they don't know, they can't recognize that that's a deal because they have nothing to compare it with and no criteria. So I hope that helps and answers your question there, Anne. I have a next question from Sam on YouTube. Hi, Raj. It's actually Saj. It's close enough. I'll accept that. What's the average HMO yield in Birmingham, please? Well, it depends on how you're measuring yields. and how you're calculating it. But ultimately, what I look at is return on cash employed. So how much money we're putting into a deal versus the return it's going to generate us. And depending on what type of HMOs you're doing, so for example, you could do ones, we grade them A, B, and C. A being they're amazing, fantastic on a hotel grade. B means they're relatively good quality, probably better than most of the stuff in the marketplace. And C means they're kind of average or not necessarily the best quality. And so on the grade C type of HMOs, for instance, you can buy them for less and you can get a fairly good return on those. It might be on the higher end ones that you're actually getting a lower yield, but actually you're getting much more money out because you've created a substantial uplift in the value of that property, which means when you refinance, you get much more money out. So your return on capital employed is much higher on that one than the other one. So I don't actually use that as a metric, just personally speaking, when it comes to looking at the return on properties. I'd rather work the other ways. What is it we're trying to achieve? Which type of property investing will allow us to achieve that? So a lot of the investing I do is with other people's money. I have other people's money either lending money for projects or partnering with me on projects. And then what I'm looking at is what is it we're doing? How can we produce the returns that we want in order to produce a good return for us and also for the investor as well that's funding that particular project. So I hope that helps there. Remember, this is something I do every Monday evening at 8:30. So make sure you get your question put in nice and early so you can get it answered. I'm here for about half an hour. On my YouTube channel, we also have 3 videos a week to, as I said, to help you get further faster in your property investing journey. And, you know, in these sessions, I can just scratch the surface a little bit and answer a question for you. If you're looking for something much more personal or more support, you can reach out to us at the Saj Hussain, either on Facebook or Instagram, on LinkedIn as well. In fact, the connection on the bottom of the page, the video just now. And you can reach out and send me a message and I can let you know how we could work together. So let's get our next question up from Game King on YouTube. Hey, do you know any type of mentoring in the West Midlands? So depending on what you need by mentoring, if it's a property mentoring you're talking about in terms of mentoring in property investing, that's something I can help with depending on where you are. I have 3 programs. We call it the startup, speed up and scale ups. Depending on where people are, startup is really for those that are brand new, just starting out in property investing, probably with little or no experience. The speed up program is those that already have property, they've already got some experience, but they really want to push themselves further to build it up to something bigger and get more momentum in terms of what they're doing. And the scale up tends to be bigger projects where people are already very experienced and they just really want to get to the next level. So I have 3 levels of mentoring. So if that's the question that you're asking, reach out to me and then we'll see how we can help you with that and give you some more details on that. Our next question is from Samra saying, hi. Hello there, Samra on Facebook. And your question is, are HMOs successful in the south, i.e. London? So I guess it's a fairly broad question. Are they successful? So let's define what we mean by successful. Are there already lots of them there? Are they running? Are they letting rooms? Are they collecting rent? Yes, there's lots of people doing that. There's lots of people I know personally that have HMOs in the south. But the thing that you've got to remember, which is probably more angled towards your question that you're asking, I expect, is that the returns can be lower. And the reason the returns are lower is because what you have to pay to purchase the property initially is significantly more than if you went further up north in the Midlands or further north again. So you pay a lot more from the property for the property to start with, and then you've still got your conversion costs, which will probably be the same regardless of where you are in the country. They won't be massively different. And then your rents will vary as well, depending on where you are in the country. But when you look at the returns on how much you're spending versus what you're generating, down south, they are very, very low. And in fact, I know of some people who sold off their portfolios in recent years because they were returning very, very little for them. However, what they were able to benefit from is a significant capital growth. So if you look at the last 10, 12 years since the last crash and then when the prices started to recover, the London prices have gone up significantly and certainly created more capital growth than anywhere else in the country. So although you will have probably returned a much lower profit, if you like, based on your investment on HMOs in the south, you've got significant more capital growth. So when investing in the south, it's not always about the monthly return or the yield or whichever calculation method you want to use in terms of your annual profit. It's really about the capital growth that you will get over time. Personally, I think it's more speculative because there's no guarantee, there's no certainty you'll have that capital growth. Yes, historically, we can see London's always been very strong. It gives us that growth, so I completely accept that. But you can't predict it. You can't say this time next year it's going to be this. So my preference is to be earning money now, right now, for our investment. So when we're investing now, I want to see that return immediately, not only for me, but also for my investors as well. And then in the south, if people are investing there, then you are relying on some of the speculative capital growth. So I hope that answers your question. I'm not sure I fully understood it, but I think that was the question that you were just asking. So let's get our next question up then. This is on YouTube. It's Trillion Beats. Hi, Saj. If you are buying a property to live in, would you wait until next year when you could potentially take advantage of a B&B deal? So this is around, the question really is around, are prices going to fall next year? Are there going to be more distressed sellers in the marketplace? There's going to be more motivated sellers. Are we going to potentially be able to get a better deal in the coming months as opposed to now? So again, we don't really know for sure. You know, earlier in the year, as I said, we were talking about it's going to be a massive crash if things continue the way they have been. But actually, things haven't. They've changed. The government's put all the support measures in place. So we don't know if the market's going to crash. As I said, I suspect it's probably going to slow down. But none of us know for sure. So I would not necessarily wait, because the risk of waiting is you could miss out completely. So you set the criteria in terms of what it is you're trying to achieve, and if it meets that criteria, then I'd look to still go ahead and do that deal. But I wouldn't rush. If it fits your criteria, great. If it doesn't, then wait, because it may be that something else comes along in the near future, or the next few months, that does fit your criteria. And of course, when someone's buying their home, and this is often the case, we're not necessarily looking at it in the same way. It's more of an emotional purchase rather than one that's based on pure logic and numbers and does it produce a return. Because a home is something you're going to enjoy and benefit from. You know, if it makes you some money, great, but that probably isn't the primary objective in terms of why you're purchasing a home. So I hope that helps you there. So we've got some people watching on Instagram as well. We're on a different camera over here. So just saying hi to all those watching on Instagram. Let's see what we've got on our next question. So this is Wahab on LinkedIn. Hi, Saj, what's your top 3 tips for finding a property? Well, I guess it depends on what it is that you're looking for. And it comes back to a little bit about what we were talking about earlier on, about if you don't recognize and you don't identify clearly what it is you're looking for, how are you going to find it? So some of it is about proactive marketing and some of it's reactive marketing. So what I mean by that, so proactive marketing is when we're going out and doing some marketing that will bring people to us. So, for example, we might be reaching out to agents. We might be doing some direct marketing to sellers. We might be talking to people in property forums and sources about finding us property. So this is when we're reaching out. We're being proactive. A reactive marketing is we set a criteria on Rightmove, and when it hits that, it will send us an email and say this property probably fits your search criteria. So, you know, depending on what it is that you're looking for and how difficult it might be to find that, you know, I would suggest you're doing a number of different things each day to be finding property. So, for example, as a property investor, if you're looking for deals, so for example, as us as a HMO investors primarily, new build developments, commercial conversion, when we're looking for these type of properties, we're scouring all the time what's happening online, any new stuff that's on the market on all different platforms through agents and contacts and other sources. But at the same time, we're marketing direct to sellers. We're saying, look, you know, if you've got this property, we can see that you have this property. If you're interested in selling, you know, let's have a conversation because we're looking to buy right now. So, you know, it's a multitude of different strategies you can use, but ultimately it does depend on what it is that you are looking for. So, for instance, if you're looking for below market value versus, let's say, you're looking for rent to rent, the strategies will be different that we'll use to find a property. So, it really does depend on what type of strategy that you're following. One of the things that people say to me, what do I do? What's my strategy? So ultimately, my objective is to do deals in and around Birmingham. That's whether it's HMO properties that we're taking on, we're converting, or we're renovating to a kind of really high standard. We do some flipping where we're buying, renovating, and selling on. If we can take a commercial building and repurpose that to residential use, or we can build out of the ground residential property. These are the sort of things I'm interested in. These are kind of projects I'm looking at. As I said, the way I tend to do that is I partner with other people. So what I say is I use my time, skill, and experience to find fantastic property investment opportunities, and I partner with those. I've got the cash, so we share the profits. And there's many different ways we can structure that, and that's primarily what I look for and how we acquire those projects, and how we also fund so many deals as well. Sometimes people ask, how do you do so many deals? Where will the cash come from? Well, it comes from other people that are investing with me. That's where the funds come from. So how are we doing for time? We're okay. We've got a few more minutes, so let's get our next question up. Next question is on YouTube, which is Jazz. Can you evict tenants right now legally, or has COVID affected the process? It absolutely has affected the process. So you can't just evict tenants in the way that we would ordinarily, like our Section 8, Section 21 notices, whether they're in arrears or anything else. So there's some extreme circumstances like antisocial behaviour, or if there was, I think it's 9 months arrears pre last lockdown. I can't remember the exact criteria, which is very recently released. I have a lettings team that work for me, that manage our property, so I'm not involved on that on a day-to-day level. But in terms of serving notices, right now it's 6 months notice that you have to serve. So there's some patience that we have to have as landlords. If there's an issue where we need to evict a tenant, I would strongly encourage you to speak to the tenant, get them on side, understand what's going on, what the issue is, why you want them to leave, what the problems are, and how you can come to some kind of amicable solution. Because right now the law is certainly not on your side when it comes to getting your property back as a landlord. What have we got next, Khalid? So next question is from Alfred on LinkedIn. When you add value to a property, what type of loan do you use when you renovate the property? So when we're adding value to a property, it depends again on the type of transaction it is. So my preference is we buy for cash the property, because it also means we can purchase very quickly. We can get transactions done like that. We commit to them very quickly as well, because we know we can tap into the funds to get the deal done. So I'm working with lots of investors. And then in terms of the renovation, we tend to also finance the renovations in the same kind of way. Then we might be refinancing at the end in terms of remortgage, or we might be selling the property. Now, not everybody has the luxury of being able to tap into investment funds in that way and buy for cash. So what are the other options? Well, sometimes people might be purchasing on a mortgage if the property is mortgageable, and then you might be looking to add some value. So in terms of what value, where can you get the funds from? Other people's money is usually one of the best places to do that. Now, if you have got a deal that you can create a significant uplift on, sometimes you can development finance. And the way the development finance would work is they look at what's the end value, what you're trying to achieve, and they might give you, say, 70% of the purchase price. So you've got to put 30% of it down, and then they give you the rest of the money, drip feed it out for you to develop the property. And let's say you're going to convert it to 3 apartments or something. So they'll release you some of the money so that you can develop it out. So that's development finance. That's another way to do that. And of course, if you've got other properties, portfolio, other investors that you're working with, what you might be able to do is tap into those funds as well. So let's get our next question on, Khalid. So next one's from Peter on Facebook. Is it a big difference between rent in percentage from HMO you're managing and HMO you give to social housing, rent percentage? So I think, Peter, the question you're asking in terms of the rent, what's the percentage difference between the rent that we get for social housing versus the rent that we get for professional houses? So the rent that we get in a professional house share, as I said, we tend to grade the properties A, B, and C. That will vary for a small room in a grade C from about £300, going all the way up to about £800 for a good quality grade A room. Often a studio or an ensuite room. So that's quite a range in prices in terms of what we can achieve rent-wise. And of course, the location, the size, the quality, all these things has an impact in terms of what we can achieve for the rent. But when it comes to social housing, the social housing is it's less concerned about its location, the size, and that it's pretty much determined by what the person's eligible for, what they call rent settings, where they decide how much that person is eligible for. And the easiest way to look at that is if you look at what the LHA rates are. The LHA rates are local housing allowance rates. You can just Google it, you get the government website, and you put your postcode in, or the local authority where the property is in, and you tell what the rates are. So I think in Birmingham it's about £57 a week. So what does that mean? So let's say it's £57 a week. Let's say we've got 6 people in there. So over a year, so that translates to about £1,482 at £57, if I've done that right. 57 times 6, 2, yeah, so about 1482 if it's £57. So that gives you a kind of base price. But of course, in social housing, or for example in supported living, the rent is part of it, but then the person that's been housed in this way will be given additional support, coaching, and helping them get back on their feet. So they're entitled to more than just a basic rate, as it were. And that's why social housing can be more profitable in that way. So, Khalid, have we got time for one last question before we wrap up? So we'll take this as the last question before we wrap up. And this is from Cal on YouTube. What is a good number of rooms for a vanilla single let in Leeds 2, 3, 4? I'm not sure I fully understand the question. What's a good number of rooms for a vanilla single let in Leeds 2, 3, or 4? I guess with that, Cal, what you'd probably need to do is just jump on something like Rightmove or Zoopla and just look at what the rates are in terms of what rents people are getting for a 2-bedroom, 3-bedroom, and a 4-bedroom property. So you can look at what rents are typically in the marketplace, or if you're struggling to find that information, check with the local a few different letting agents to get the range of rates for 2, 3, 4-bedroom. And then you've got to look at what's the cost of purchasing a property in that way. So if you purchase a 2-bedroom, typically a 3-bedroom or 4-bedroom, what is it you're going to pay? And then you can look at what the returns are. So what's the return on a 2-bedroom, a 3-bedroom, 4-bedroom? Just put in a simple spreadsheet and you'll be able to work out then which is probably going to be the one that's going to produce you the better return on your money, whether it be a 2-bedroom or a 3 or a 4-bedroom. And of course, that's looking at the rent in isolation. Remember, just as we were speaking about earlier on, in some places you'll get better capital growth than others as well. So for example, purchasing the cheapest possible area, normally, you'll get a good rent return as long as you can minimize those voids and the damages. But you're unlikely to get great returns in terms of capital growth over time. Whereas if you buy in the nicer areas, more suburban parts, you'll end up paying more for the property at the beginning. You might get a lower return on the rent, but of course you've got the capital growth that you can build in as well. So I hope that was useful. Just leaves me to say thank you so much for spending your Monday evening with me. I hope you found that beneficial. Remember, I'm here every Monday at 8:30 p.m. on various different platforms: Facebook, YouTube, LinkedIn, Instagram, and Twitter. And if you found this useful, share this with one other person to let them know how useful it was. And remember, I'm here every Monday evening, so I look forward to seeing you again next Monday at 8:30. Thank you so much.